name's James Hughes, Chief Market Analyst here at Scope Markets, and this is your daily briefing. Markets are set to post gains as we approach the open in Europe, and that's despite more worrying news and fears of a second wave of infections from coronavirus. Many are now worried that after hoping for a lockdown easing for so long, that opening up too fast will cause a second spike in infections, leading to stricter lockdown measures for longer. Yesterday saw the amount of cases reported in Germany triple after lockdown measures were eased. There is now the possibility that stricter measures will be reintroduced after the R rate of infection jumped back above 1. This is a fear for many countries, especially the UK, after Boris Johnson announced an easing of measures at the start of the week. The reason the UK is looking to act so quickly to get the economy back up and running was shown on Wednesday morning after GDP data showed that the economy contracted by 5.8% in March and by 2% in the first quarter, while manufacturing production fell by 9.7%. Both of these numbers were actually slightly better than had been expected, with forecasts for the monthly GDP at negative 8%. However, there is still no hiding from the fact that the economy remains on course for the worst recession since the 1930s. In the markets today, the rest of Wednesday's session is expected to be dominated by a speech set to be given by Fed Chairman Jerome Powell later this afternoon. Many are focusing on whether the Fed chairman will talk about the prospect of negative interest rates in the US in order to give yet more help to the economy. The Fed has already slashed rates and pledged trillions of dollars in aid to help combat the effects of the pandemic. The expectations that the speech will bring about some key policy decisions not seen before in the US has led to optimism from investors. However, we think Powell will resist the calls for negative rates despite the very real prospect of deflation and ongoing pressures from US President Donald Trump. Worryingly, in the past, the Fed have caved to pressure from Donald Trump on monetary policy, despite supposedly being an independent body. Oil prices remain solid as we continue to push towards the end of the June trading contract. Last month's move into negative prices has many worried that we could see a similar picture once again at the expiry of the June contract next week. Demand is yet to pick up significantly enough, however, moves by OPEC to extend output cuts away from their original agreement could have an ongoing effect.